There is one quality which one must possess to win, and that is definiteness of purpose, the knowledge of what one wants, and a burning desire to possess it. Napoleon Hill. Ever open a stock chart and feel like you're staring at spaghetti? Lines everywhere, red ones, blue ones, some sloping up, others dipping down. And you're left thinking, what does any of this even mean? Well, you're not alone. For so many new traders, these moving lines feel more like moving targets. Confusing, overwhelming, and downright discouraging. You want to trade smart, but instead you're stuck second guessing every move, wondering if you're doing it all wrong. You've got the passion, but the confusion is killing your confidence. And worst of all, you know the answers are right in front of you, but nobody's explaining them in a way that makes sense. But breathe easy, fam, because that confusion ends today. In this video, we're breaking down those intimidating lines you keep seeing on your charts once and for all. You'll learn exactly what the simple moving average is, why the exponential moving average reacts faster, and how the VWAP can help you spot institutional interest and volume-based pressure points. So sit back, grab a pen, and get ready. Because we're about to simplify the most complicated lines on your chart and show you how to use them to build your confidence, sharpen your entries, and become the successful trader you were meant to be. Let's turn this mess into mastery. Hey fam, I'm Dr. O, a trained psychotherapist turned full-time trader and the founder of Trading Psychology for Reparations. I help the Black community understand one powerful truth. Your trading profits are not hidden in math or science. They're hidden in your psychology. In my program, I show our marginalized communities how to tap into the stock market, not just to chase profits, but to reclaim the reparations that were never formally handed to us. No more waiting on the government to fix our financial challenges. You've always have the resources. They're already within you. And my job is to help you access them, master them, and multiply them. In today's episode, I'm breaking down 3 of the most commonly misunderstood tools on a stock chart: the simple moving average, the exponential moving average, and the volume-weighted average price. By the end of this video, you know exactly what each line means, how to use them, and how to read them like a pro, so you can stop trading in confusion and start trading with confidence. If you're already feeling this message, go ahead and drop a comment, hit that like button, and subscribe, so we can keep reaching more Black families and building the kind of financial freedom that creates legacies. Let's get into it. Let's begin with the simple moving average, also known as the SMA. This is one of the most foundational tools in technical analysis, and it helps traders smooth out price action by creating a rolling average over a specific period of time. In plain terms, it tells you the average closing price of a stock over a certain number of days, so you can see past the noise and identify the true trend. Instead of reacting to every candle or emotional move in the market, the SMA helps you step back and view the bigger picture. For example, if you're using a 20-day SMA on a daily chart, you're simply averaging the last 20 closing prices. If SPY closed at 410, 412, 415, and so on for the last 20 trading days, the SMA would give you one clean line that represents their average. As each new day is added, the oldest day is dropped and the line updates, helping you see if price is trending up, down, or sideways. Many traders use simple moving averages together, like a 20-day and 50-day, to identify crossovers and potential trend shifts. The concept of moving averages was developed long before modern computers, but one of the most notable contributions came from Richard Donchian, a pioneer of trend-following strategies and the father of managed futures. While Donchian didn't invent the SMA outright, he popularized its use in systemized trading. The SMA has been a trusted tool in financial markets for decades, used by both institutional and retail traders alike. Its simplicity is its power. It's not trying to predict the future, but rather to help you interpret the past with clarity. The formula for the simple moving average is exactly what it sounds like, where P represents the price at each time point, and N is the number of periods, for example, the number of days. So if you're calculating a 10-day SMA, you'd add up the last 10 closing prices and divide by 10. It's straightforward, but don't underestimate its value. In a market full of chaos, sometimes the most powerful thing you can do is simplify. And that's exactly what the SMA does. Now that we've covered the simple moving average, let's take it a step further with the exponential moving average, or EMA. While the SMA gives equal weight to all data points, the EMA is designed to prioritize more recent prices, making it more responsive to sudden changes in the market. In fast-moving environments like volatile news cycles or earnings season, the EMA gives you a quicker read on what's happening right now. It's still an average, but it moves faster, adapts sooner, and gives you a real-time edge. Here's how it plays out. Imagine Donald Trump makes a controversial comment on national television. Maybe something about interest rates, China, or a high-stakes policy shift. Within minutes, the market reacts. The SPY drops sharply. The simple moving average wouldn't catch this right away because it's still averaging the last 20 or 50 days. But the EMA, it would immediately begin adjusting because it gives more weight to today's price action, making it ideal for traders who need to respond quickly to big moves driven by breaking news. The EMA was developed in part by traders and analysts in the 20th century who needed faster, more responsive tools in a rapidly digitizing financial world. While no single person owns credit for inventing it, the concept evolved out of exponential smoothing methods used in statistics and forecasting. Today, EMAs are essential in most technical strategies, particularly with day traders and scalpers who need to see momentum shifts in real time. Many institutions use the EMA in tandem with other indicators to catch early reversals or ride out trends with more precision. The formula for the exponential moving average is a bit more complex than the SMA, but still is accessible. It works by applying a multiplier to the most recent price based on the number of periods, where the multiplier equals 2 divided by n plus 1, and n is the number of periods. This formula allows the EMA to react more quickly when price starts moving fast. In simple terms, the EMA listens louder to what's happening right now. And for traders trying to get in early or get out quickly, that makes it a priceless tool in your trading arsenal. Now let's talk about one of the most respected tools in institutional trading, the VWAP, or the volume weighted average price. Unlike the SMA or EMA, which focuses solely on price, VWAP combines price and volume to show the true average value of a stock throughout the trading day. Think of it like the fair price agreed upon by buyers and sellers, weighted by how much money is likely flowing into each price level. For intraday traders, especially those who want to make moves like institutions, VWAP is the roadmap. Let's break it down with an example. Imagine it's a Tuesday morning and a major institution is about to enter a large position in SPY. They don't want to move the market too much or tip their hand. So what do? They watch the VWAP. If Donald Trump tweets something controversial about the economy or foreign policy, volatility spikes and retail traders start chasing moves. But institutional traders, they stay grounded. They use VWAP to see whether price is extended or returning to value. And they often wait for price to return to VWAP before executing their entries or exits. That's how you trade with strategy, not emotion. VWAP was created by Paul Levitt in 1984 for the trading firm Instinet, and it is designed to help large institutions execute trades without dramatically impacting price. Over time, it became a staple for hedge funds, mutual funds, and high-frequency traders because it offers a clear visual of whether a stock is trading at a premium or a discount relative to volume. If price is above VWAP, it suggests buyers are in control. If it's below VWAP, sellers might have the upper hand. This makes VWAP a powerful tool not just for entries and exits, but for judging momentum and timing. The formula for VWAP looks like this. It's calculated cumulatively throughout the day, meaning it resets each morning and updates as new trades come in. This makes it incredibly effective for day traders who need real-time volume-driven insights. It's not just about following price, it's about following where the money's flowing. And when you align yourself with volume and price like VWAP does, you stop chasing the market and start flowing with it. But let's be real. These indicators can feel intimidating when you're just starting out. The moving averages, the VWAP, all the technical jargon. It's easy to look at your chart and think, this isn't for me. But I'm here to tell you the truth. You are more than capable. You don't have to be a math genius or a Wall Street insider. You just need one thing. Belief. Belief that you can learn, belief that you are worthy of wealth, and belief that you can master the same tools the professionals use. Because these indicators, they aren't designed to confuse you. They're designed to guide you. The simple moving average shows you the bigger picture. The exponential moving average teaches you to move with precision. The VWAP helps you align with power. Together they create a roadmap. And once you learn how to read that map, you stop getting lost in the noise and start finding your way to consistent profits and financial freedom. You don't have to walk this journey alone. In fact, that's the biggest mistake most new traders make. They isolate themselves, try to figure everything out through trial and error, and waste time and money in the process. But in our community, Trading Psychology for Reparations, we do it differently. Every day, I share key market levels, trading insights, and the emotional strategies needed to stay grounded, focused, and profitable. This isn't just about charts. It's about healing, reclaiming, and rising. So, if you're ready to silence the doubt, tap into your full potential and start using tools like SMA, EMA, and VWAP with confidence, then I want to personally invite you to join our movement. Click the link in the description to become part of a community that sees you supports you, and is committed to building wealth with purpose. Don't forget to comment, like, and subscribe so we can keep reaching more Black families ready to break free from generational limitation. You already have everything you need inside you. Now, it's time to trade like it. You've got this. Peace and blessings, Dr. O.